first want to acknowledge that we had a fantastic day, not just the weather, but the quality of the meetings and the investors. So I want to thank March Capital, Montgomery, and almost a 10-year partnership with DC Advisory, which is the firm that I had the pleasure to work for. So I'm Tommaso Zanobini. I run our FinTech practice in New York for the US. And I have a pleasure to host three distinguished executives in the FinTech world, Sunil Sabharwal, Hans Morris, and Don Layden. Each of them really has a unique perspective on the sector. Unique in one way, which is all of them have the background of having run operationally public and private companies, as well as, on the other side, having been investors or on the government side. So coming from the right, Don had executive position at Metavante, FIS, most recently NCR. Sunil was a US representative for the IMF, as well as having been the chairman of public companies, private companies, and an investor. And then Hans Morris was, among other things, the president of Visa. He now runs NICA, which is a major investment firm focusing also on the financial services. So I'm really excited to have him on and participate in this discussion. So let me first, we talk about the future of FinTech. So I want to start by thinking about the current economic environment and how it really affects the company's ability to invest, raise capital, and pursue M&A. And maybe, Don, you can think about how you're thinking about it in your position. And you were in operational role as well as an investment role almost at the same time, so you probably can get some perspective on this.
Yeah, what Tommaso didn't tell you is that the three of us, actually the four of us, I'll include Tommaso in this, got involved in FinTech before it was FinTech. That's how old we are. And so during the course of my career, we've seen a dramatic shift. When we built a company called Metavante, it was a pretty simple equation. 1/3 organic growth, 2/3 inorganic growth. We did an acquisition every 6 weeks, and we built a company. That kind of allocation of capital today among investors is probably not going to happen. There's no way you're going to get that kind of access to capital on a regular basis to make those kinds of things happen. In the most recent public company that I was helping to run at NCR, we did the largest acquisition in the history of the company in a company called Cardtronics. Completely transformed the ATM business, right, a sleepy cash-based business, and moved that from a non-recurring revenue, sell hardware at ATMs, to a recurring revenue business that had predominantly more software attached to those sales than any other component of the sale. We were fortunate to have public company investors and board members who supported that transaction. Now, as it proved out, the street didn't support it, the analysts didn't understand it. And so I think today, as you see the kinds of things that companies like ours facing, so we do the Cardtronics deal, and immediately there's a war in the Ukraine, and we lose $100 million of revenue because we have to leave Russia. And so all of the sort of pro forma financials that you create in order to do that transaction go away. And investor allocation of capital, now they say, well, wait a minute, you probably needed some of that capital that you allocated to that acquisition. So the economic environment is much more uncertain. Even in the sort of regular economic environment of facing a recession, the need for banks to reduce their spending, and really to focus entirely on asset gathering and deposit gathering, apart from every other set of activities they engage in.
I would say that it's very hard. Obviously macro risks affect all investing. Everyone here thinks about macro risks. And interest rates is one variable. But if you say FinTech, I think to me, and I sort of agree with Don, I've been around this a long time, and I like telling people I worked on the IPO of First Data, Capital One, PayPal, and Visa. And back, even like First Data, Capital One, they were great, and PayPal, they were not blowout IPOs by any. They were, it was like, 20 PE, something like that, 22 PE. Stock went up a little bit, but when we say fintech, it is not. It's very discrete business models. They have different regulatory risks, different regulatory challenges, different exposure to interest rates, different exposure to liquidity concerns, and so I think it's even though you would say 2021. The Fed and macro factors led to tremendous repricing of risk across all asset classes. In 2022, it was probably as bad as it got. 2023, I think a lot of business models stabilized. Investors started doing more, were becoming a lot more discreet in the way they looked at different models. And in some cases, it's highly affected by macro risk assessment. In other words, it's really not. And I think in some cases, like Visa, people say it's a refuge stock. People like own it because it goes up kind of no matter what. So, but that's not true with all fintech business models.
First, let me chime in here.
Please.
First of all, it's great to be with these guys. I think we know each other for a collective total of at least 100 years. It's just wisdom here.
Is that a distinction or is that?
It's wisdom.
Yeah.
It's wisdom.
Speak for yourself.
Wisdom, and public and private sector, like you said. So what I want to add to the macro uncertainty that you guys have identified is regulatory uncertainty. I think it's become a lot more complex. The CFTC, the FCC, the OCC, the CFPB. All these guys are kind of pushing their own agenda, leaving businesses, financial services, and fintech businesses exposed. So then that has shifted over the years, and I don't see that actually getting much better in the current political environment, at least in the United States. So that's something everybody has to have in their mind.
In anything, as you create a global fintech company, so we sold SafetyPay, Latin American payments company, to PaySafe. The biggest regulatory obstacle was we had a PSD license in Spain, and the Spanish regulators spent 11 months reviewing the transaction, coming back with follow-up questions. They were a nit to the entire transaction. We finally withdrew and said, you know what, keep your license. We don't need it because we need to close the deal. It's become very, very complicated.
You talk about the regulatory environment. I think it's also connected to the geopolitical situation. How do you see that playing in today's environment, which, if you go back maybe even 5 or 10 years ago, maybe was not as prominent as it is today?
Sure, geopolitics have become much more complicated for a number of reasons, both domestic, U.S. and international developments. Maybe what's, let's say, interesting to this crowd is this debate about dollarization, de-dollarization, right? Because that's affecting financial services sector and fintech. And if you look at some metrics, let's say 20 years ago, almost 70% of central bank reserves would have been dollar-based. Today, that's closer to 50%. So it's still by far the single largest currency, but that's a 20-25% drop over a couple of decades. Now, what does that mean? The second aspect, you look at how much of global trade is in dollars versus non-dollars, and there's a slight decrease there as well. And I think these shifts are I think preparing us to be in a kind of multipolar world where, yes, dollar is still number one, but what's happening with the BRICS currencies where China, Russia, India, South Africa are banding together, starting to trade with each other? What does that mean? So I echo the same sentiment that it becomes more complex because of the geopolitical developments just on that aspect, just on the dollarization aspect.
Yeah.
Sunil, I know we're all supposed to talk about AI, but if we take a step back, to blockchain technology and maybe think more about stable currency. For those of us who have been involved in global fintech companies that have to move money around the globe, eliminating some of the currency risk, the interest rate risk, and trying to move to a stable currency against the blockchain is at least superficially attractive. And so, do you think that there's any real prospect for that happening, or we're going to continue to have fiat currencies?
Well, so that's a fascinating question. When I was at the IMF, that's when we first started talking about CBDCs, central bank issued digital currencies. And this is now 5-6 years back. Today, you wind the clock forward, there isn't that many out there. China has the lead and is working, and otherwise you can probably count on one hand the ones that are out there, mainly in island economies and not very effective. Of course, the US digital dollar is way behind. But what's interesting linked to that is the emergence of stable coins, right? And everybody has heard and that Circle has filed for an IPO. Circle had 4 years ago $0 in issues. Now it has 40-50 billion USDC in issue. It kind of goes back to my prior topic about dollarization, de-dollarization. So on one hand, the fiat dollar is losing ground, but 90+% of stable coins are dollar denominated.
Correct.
So it's a real interesting, it does create a lot of opportunity, I would say, for stable coins in some way, because it gets rid of some of the friction that is there in traditional cross-border payments. However, that's where the regulatory landscape comes in. The US hasn't been able to get any stablecoin legislation off the ground, while some other countries have developed more. But fascinating question. I'd love to hear Hans.
I think, well, to me, this is the 10th year anniversary of NICA, so I've been thinking a lot about, okay, what's changed over 10 years and I think in payments, it is quite interesting to look back and say different parts of the system, how much they have changed. And I'd say we could pick a million, like how many omni-channel merchants where everything was one single system, one database. It was pretty much zero 10 years ago. Now pretty much everyone's omni-channel. How many Verifone and what you call it, the French one, the big processor. But anyway, they were 85% in Jenica. And now they're like down to like 27% combined share. Everything is a smart terminal. When was the last time you didn't go and see a smart terminal? So the software is now talking to the payments, and you're pulling in lots of other intelligence. It's linking into all of the other systems. And so I look at payments. I also think a lot of infrastructure has been laid, which is going to make the next 10 years even more dramatic, because 85 countries now, real-time systems, B2B payments are starting to really become more real-time, and companies are interested in employing them, and all the risk and optimization that goes with that. It's going to be a lot of change. Stablecoins and crypto, I would say, is actually a pretty big disappointment, because outside of speculation, the business applications have been pretty much zero in terms of impact. And so the question is, will that change? And I think, to me, on stablecoins, one big fact, which I just read about, which is, the Nigerian currency, the naira, is down about 75%. And stablecoin purchases in Nigeria, it's like 4 billion in a short period. Now, I don't know if the central bank may try and shut that down, but you don't have, the problem is moving money in and out of a stablecoin is expensive. When you want to get to fiat, that's where the costs and the risks are. If you leave it there, you don't have to do it, but that has not really, businesses are not at that risk tolerance yet, I don't think. There's still a lot more, but I'm actually thinking it could change quite dramatically. So,
Hans, you mentioned, it was interesting when you brought up the IPO, which I live personally of First Data and Capital One. Now you're going back 10 or 15 years. And one question that I was thinking is, so let's go back 10 plus years ago. What lesson have we learned from companies that were back then at the forefront or perceived forefront of technology? How many of those actually have become leading edge today versus business model and technology that failed? And how do you apply those lessons to today's new technology? Whether it is, we talked about the integration of payment and software. We talk about how there are other sectors that, whether it's AI, that could take over even FinTech, crypto. So try to apply also those lessons to today's environment. Where do you see it?
So here's a couple of lessons, which most of you will forget everything we discussed today. But I would say one thing to keep in mind is there's a big difference in business models if you have risk retention as part of your revenue generation. So if I'm lending you money, or I'm insuring your life, or I'm trading bonds or something, then I need I'm retaining risk.
Yep.
I need capital to support that risk. It's a fundamentally different business equation. And if you look at the FinTech companies, where that's been core to their business, so lending applications, things like real estate risk assumption, like I'm going to let you sell your house and I'll take that risk. That's been a total disaster, right? Because I have risk retention and it's hard to do. But even things like a lot of the insurance models have not been very good because, in fact, the FinTech company was not very good at either predicting risk, so the risk return analysis, a lot of those models was not very good. You were subsidizing the risk. And so that's one thing. That's not a new lesson. That's a really old lesson, but that's one that is an enduring truth. The second thing is everything in financial services, I would say, is regulated for a good reason. There is no escaping regulation. Governments can do a lot. And actually, it's important in society. So many of the FinTech founders, and I think many FinTech investors, overlooked that. They said, this won't apply to us. But as soon as you get big and successful, it will definitely apply to you. And
yeah, and so if you're thinking about either the need for capital, the need for balance sheet, there's a reason for it. The need for regulation is not simply, well, we're in the new technology world, let's forget about all of that. It's actually important.
Yes, and the last thing I'm going to say is the incumbent response. I can't tell you how many pitches I went to where the founder would say that these banks, these insurance companies, asset managers are so stupid and they're overcharging and doing this stuff. And I'd say, you look at deposit growth and say how much deposit growth was digital deposit origination, like over 100% of all deposit growth is digital now. Of net deposit growth, but a lot of it's J.P. Morgan Chase and Wells Fargo and Citi and Capital One and Ally, and because they're using the same tools. They didn't just sit there and let their lunch get eaten. Wealth management has changed in many ways. A lot of pricing practices and things have changed, but how much wealth management? UBS probably grew in a quarter more than all of their FinTech wealth managers did in a year. So that's another thing, which is the incumbents have a very complex infrastructure they're sitting on. It's hard to change it, but they're spending a lot of money, and they are changing. And I think we will, as I said, a lot of infrastructure has been changed and tools exist. So I believe the next 10 years there will be a lot of change.
I think for me, one of the big fundamental questions is whether the public markets are good for FinTech companies as they evolve. Public investors are, I think, not well aligned to the strategy of a lot of FinTechs. They don't appreciate the risks. They don't appreciate the regulatory environment, and the predictability therefore is difficult for them to price. And private investors are much better aligned with management, and they're much better aligned with understanding the complexity of those transactions. I think, again, I've been executive officer of 4 public companies, CEO of one. I'd be hard pressed to say that I found a single analyst who really understood our business.
Yeah, it's also a factor of the business model of a lot of those companies, because there's a premium that is clearly there for growth versus some of the other margins and other P&L dynamics that the public investors defaults to. And so how do you charge and how do you appreciate that versus the other? And sometimes in the public environment, you're constrained for what is that you should be doing as a FinTech growth company, right?
I remember when First Data went public, You have to go to every single meeting and explain interchange and what the acquirer does. And even when Visa went public, we had to explain interchange. I mean, every single meeting, you had to go in and explain it. That's not so true. You go now, I mean, I would say the questions at conferences and stuff are very, very technical, and a lot of the analysts and the big investors understand that. But I won't mention the investor, but a well-known investor invested in Lemonade, and he said, but he also said that he regretted it. He said, he said in the entire roadshow, there's not one mention of claims. Never came up. There are no claims in this business, and so that, I guess, turned out to be a surprise to everybody. There are claims in the insurance business. So.
I would say another thing to bear in mind is coming back to the payment space a little is looking at last 20, 30 years, looking forward, that it just becomes more complex, and old payment methods don't go away. Just new ones get added on. You have cash, you have checks, you have all the different cards, mobile payments. And that actually creates an opportunity for really embedded FinTech payment providers. You were an investor, Hans, in Payoneer. In terms of payments orchestration, they took the lead. I'm involved with a company, Finexio, which is of course, trying to get rid of checks of trillions of dollars, but in the process of that, of course, always making for the customer the right type of payment, and it gets ever more complex every year, even domestically, let alone internationally. And then you add the layer of the faster payment schemes, Hans, that you were mentioning today. We have some 60 countries covering 90% of GDP with faster payments, the US being one of the last ones. Yeah. But of course, the next frontier is to start connecting these. And then you go back to geopolitics, who wants to be connected with who. Yeah. But certainly, like-minded countries could be connecting and creating a much more efficient global cross-border payment system.
So let's bring it all together. We talk about the past, we talk about what we see in the future, but if you are looking at the next 6, 12, 18 months, what is your view on the future of financing and M&A activity? And maybe, Don, you can start, but I would really love to hear your view. And what do you think is going to be the catalyst to see some real pickup?
Yeah, I think it's going to be a very robust market. I think that evidence just of this conference, the kind of companies that are here, the focus on private companies. Private companies are building an interesting part of the ecosystem that frankly, the kind of companies that Hans and Sunil and I have kind of helped grow those businesses. They don't have the ability to do that innovation anymore. So they've got to really go find that incubated product somewhere else. They've got to get off balance sheet risk capital to build those. And then they're going to pay up on the acquisition side. We even on a simple basis at NCR, on our digital banking platform, we needed a sales platform, and we spent more millions of dollars than I care to admit, and we couldn't build it. Mm-hmm. It's not a cultural environment where that kind of innovation took place. A Bay Area company called Terrafina. Great team, built a really nice product, and now we acquire the company and we triple the size of the company in 12 months because we can push that through our digital banking platform and deliver that to customers. So I think that kind of function, I think it's going to continue to be robust. I think it's going to continue. There's no doubt in my mind. I mean, I'm an advisor to Casisto, an AI-driven chat Gen AI company. We couldn't build that, in any of the FinTech companies that I whether it was FIS or Metavante or it doesn't matter. We had no capability to do that, and no risk tolerance to do it. In the allocation of capital, particularly in public companies, you're not going to get $100 million to go do that. Yeah. So I think it's going to be a really interesting time, and I think. But I also think that a lot of this has to be purpose-built. As these companies get created and start to think about what they're doing, you got to almost have to start on that same sheet of paper with where's the exit? You know, how do I get out of this? Because you don't want to run it for 10 years. You know, you want to get there, prove the market, prove the pricing, and sell, and then move to the next activity, I think.
So there's two, I agree with that. And one, if you look at Fiserv, just to pick one company, so Fiserv's, the big growth engine of Fiserv is Clover, which is a company they bought for, you know, $40 million, something like that, I think. And then actually you compare, you know, with everyone, I think would agree that cloud-based banking cores are the future. It's impossible. You know, the efficiencies are so dramatic, and it allows also modular conversion around the big bang conversion. So FIS went and built a cloud-based core, at least $1 billion, and it's got at least it's got a lot of,
and probably has cost them 2 CEOs.
Probably, yeah.
I mean,
and Fiserv bought Finxact, Visa bought Pismo. Because I feel like if you said, let's go build a banking core, you know, yeah, it would, even if you had $100 million, it would.
And honestly, if you want to build a banking core, build a digital bank. Like, look at a company like BankJoy, who's presenting here. They've raised $17 million. They have a fully functional retail go-to-market platform that works for banks and credit unions. And it works, pick a number, 100 times better than FIS, Fiserv, Jack Henry's combined.
And on a single platform, too.
Correct.
Yeah.
Yeah, I'll tell you one more thing that where I see M&A happening. So to go public, I know you had a session on today. I didn't go to this, but you know, most ECM people that I talk to would say, look, you got to have 250 to 300 million. You have to be profitable. You have to show that you have a compelling go-to-market in every component of that. So I think there's lots of companies that are, let's say you got 150 million in revenue. That's a very nice company and you're pretty profitable. There's other companies that have been around for 7-8 years and they have, let's say, 20 million in revenue. A couple of years ago, that $20 million company could still raise money and would be, you know, the CEO would still say, let's go for it. We still think we're going to be $1 billion company. I'd say the energy behind that point of view is a lot lower, and so I think there's strong interest in the winners, but they could use some consolidation to get to that standard where there's an exit. And I think some of the companies that are not losers, but they're not the big winners, that there's a good reason for them to consider merging for equity. And so that would be another catalyst I can see.
Yeah, I double down on that is, you know, your consolidation point, which, you know, in one sense it could be just buying the same thing, but the flip side of the house, you know, if you're doing AP, the AR, if you're doing payouts, the pay-ins, so, you know, if you have the customer, might as well add the capability either organically or by acquisition on the other side. And I actually see a lot of that happening. You know, build value from your existing customer base.
Well, you can see the energy. You can see where the sector is going. So I want to thank you for giving us really good input, a lot of experience. I'm utterly excited myself. Companies that are here that I invited are presenting, they all share these features of having disruptive technology, really fast growth. So I think it's a good place to be in. And I want to thank you for providing your input today. Great panel. Thank you.
Thanks. Thank you.
Thank you.
Thank you, guys.
Thanks.
All right.